Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today's topic is methods and sources of raising capital. So this is one of the most important factor in any type of organization because if they want to run their business, they need to have some kind of sources. How do they raise the capital from different sources? What kind of methods the companies are going to adapt? So, after going through this topic, the learner will be able to understand the meaning of sources of finance, importance of finance, types of financial needs, and methods of raising capital. So, let us start with the introduction. Every business activity requires money to run it. Take the case of manufacturers, or if you take service oriented organizations, everybody wants money to run their business. So, adequate capital is necessary for financing various activities of the business. Therefore, raising of finance is a prerequisite for setting up any business unit. So, before going to establish any business entity, the promoters, what they used to do, they used to search for the sources of finance, whether the company may have adequate capital. If not, from where they should get that capital. So no one can start a business unless adequate capital is available. They must have a place to produce goods. They must buy machinery and raw materials, engage workers and managers, pay for electricity, water supply, and incur expenses for delivery of goods to their customers. Similarly, they take the case of traders. They must buy goods and have godown to keep them. They have to arrange for the delivery of goods to their customers. They must employ people for loading and unloading of goods, for keeping accounts as well as for bill collection. Coming to the importance of finance, the importance of finance has increased in modern times for two reasons. First one, the business activities are now undertaken on a much larger scale than in the past. If a business is started initially on a small scale, it grows in course of time. There is increasing need for finance with enlargement of business. And second, the manufacturing processes have become more complex than in the past. Factory production requires expensive machinery, equipment, and tools, and many men. So, without these productive resources, no company can produce goods and services. So, it requires large quantities of material to be procured and kept in stock. The products must be widely advertised. Distribution of the products must be arranged through wholesalers, dealers, and salesmen. So, thus, with the growth in size and volume of business and with the increasing complexity of production and trade, there is a growing need for finance. In an existing business, on the other hand, money must be spent before money is realized from sales. So, if you want to maximize your profits, so for that we need to sell the produced goods and services. So, for that we have to spend some amount of money so that we can realize profits through sales. On the other hand, cash realization on account of sales over a certain period may not be equal to the amount of expenditure incurred during the same period. So, finance should therefore be available in adequate amount as and when required. So, to anticipate what amount of finance will have to be arranged at what point of time is not an easy task. This is because business conditions may change from time to time. Coming to the types of financial needs. So basically financial needs we used to categorize based on performance and based on period of use. So based on performance we have categorized into two types, fixed capital and working capital, whereas based on period of use the capital can be divided into two, long term and short term. Then what is capital structure? So before going to know about the sources of fund, the types of financial needs, one should understand what is capital structure. The fund tries to meet both the long term and short term capital requirements, may take the form of ownership capital or borrowed capital. Ownership capital is nothing but the capital invested in a business by its owners is known as ownership capital. It is on the basis of their investment that owners become entitled to the profits of the business. The rate of return on owners' investment it depends on the level of profits earned. If there is no profit, the owners go without any dividend. But in case of profits, the owners they will go with the amount of dividends. The risk of losses and of low rates of returns are thus associated with ownership capital. Hence, ownership capital is also known as risk capital. Ownership capital may be used for financing fixed assets as well as continuous investment in current assets. So, it is generally used as permanent capital or long term capital. As risk bearers, owners do not have any assurance whether they will get adequate returns on their investment or not, but they receive high returns if the business is successful. Then second type of capital is known as borrowed capital. The financial requirements of the business are often met by raising loans. So loans carry a certain fixed rate of interest which must be paid at regular intervals, half yearly or yearly. There is also a commitment that the principal amount will be repaid in due course. Thus, if loan is raised for a period of 10, 15, or 20 years, its repayment may fall due to the end of the period after stated intervals according to the terms on which the loan has been raised. So, interest on loan is a fixed expense which has to be paid irrespective of the income. Either you may have income or not, but we have to repay the loan. Thus, borrowing of money involves fixed obligation to pay interest and repay the principal amount as and when due. The next, coming to the methods of raising capital. Funds raised to meet the financial requirements of a business can be classified as ownership capital and borrowed capital. The amount of capital invested in a business by its owners, proprietors, partners, or shareholders is known as ownership capital, whereas borrowed capital may be raised by way of different loans, by issue of debentures or bonds in the case of a company. Ownership is raised by companies by issuing shares. Borrowed capital is often used to drive the benefit of higher rates of return on owner's investment. This is known as trading on equity. So, if you see these methods of raising finance, there are three types of finance we are talking about: long term capital, medium term, and short term. So, long term capital further divided into three types: equity shares, preference shares, debentures, whereas medium term capital categorized as retention of profits, bank loans, public deposits. Coming to short term capital, it may be divided into factoring, discounting bills of exchange, and bank overdraft and cash credit. The size and nature of business determine the total amount of financial needs. So if the size of the firm is large, then the amount of financial needs also very high. The scope of raising funds depends on the sources from which funds may be available. For a sole proprietor, there are limited opportunities for raising funds. He can finance his business by any of the following means. So he may go with investment of own savings or raising loans from friends and relatives and arranging advances from commercial banks or borrowing from finance companies. So these are the sources of raising funds to the sole proprietorship form. In case of companies, there are a number of methods of raising finance. To raise long-term and medium-term capital, companies have the following options: issue of shares, issue of debentures, loans from financial institutions, loans from commercial banks, public deposits, retention of profits. So these are the sources how the companies they use to raise finance. The following methods may be used to finance short-term capital, where we used to discuss about trade credits, factoring, discounting bills of exchange, bank overdraft and cash credit, public deposits. And coming to the issue of shares is the most important method of raising long-term capital for companies. So there are two types of shares. One is equity share, another one is preference share. Equity shares are nothing but there are several advantages of issuing equity shares to raise ownership capital. The rate of dividend on these shares depends on the profits available and the discretion of directors. There is therefore no fixed burden on the company. And second category is preference share. Issue of preference shares is another method of raising long-term capital. It has certain merits. Dividend is payable on preference shares at a fixed rate and is payable only if there are profits. If there are no profits, no question of paying dividend. Hence, there is no compulsory burden on the company's finances. Then second one is issue of debentures. Companies generally have powers to borrow and raise loans by issuing debentures as securities of specified face value. The rate of interest payable on debentures is fixed at the time of issue and they are recovered by a charge on the property or assets of the company, which provide the necessary security for payment. So, debentures are mostly issued to finance the long term requirements of business. So, whenever the company want to fulfill their long term requirements, then that time the companies issue debentures. There are certain advantages of issuing debentures. The first advantage is that because of fixed interest on debentures, companies with stable income can secure higher returns on equity capital by trading on equity. And second one, the rate of interest is usually lower than the expected rate of return on share capital. This is because debenture holders do not bear any risk. And third one, debentures do not carry any voting right. But whereas in case of equity shares, the equity holders they will have right to elect in the company's directors. Election of the company directors that may be possible in case of equity shares, but whereas in case of debentures, debenture holders they never have the right of voting. Hence, management by promoters or existing directors remains unaffected. The loans from financial institutions is another source. Long term and medium term loans can be secured by companies from financial institutions like the Industrial Financial Corporation of India, Industrial Credit and Investment Corporation, State Level Industrial Development Corporation, etc. So, these financial institutions grant loans for a maximum period of 25 years against approved schemes or projects. Loans agreed to be sanctioned must be covered by securities by way of mortgage of the company's property or hypothecation or assignment of stocks, shares, gold, etc. And next, loans from commercial banks. Medium term loans can be raised by companies from commercial banks against the security of properties and assets. Thus, funds required for modernization and renovation of assets can be borrowed from banks. Generally, 50% to 75% of the value of industrial assets is granted as loan after the bank is satisfied about the earning capacity of the company and its ability to generate sufficient cash flows. So, before going to provide loans to the companies, the banks also check the credit worthiness of the company, whether they can able to repay the loan or not. Then comes public deposits. Companies often find it convenient and necessary to raise funds by inviting their shareholders, employees, and general public to deposit their saving with the company. So the Companies Act permits such deposits to be received for a period up to 3 years at a time, and thus public deposits can be raised by companies to meet their short term and medium term financial needs. It is a simple method of raising finance for which the company has only to advertise in the newspapers, giving particulars about its financial position as prescribed by the Companies Act. The next one, retention of profits. So, profitable companies do not generally distribute the whole amount of profits as dividend. A certain portion is transferred to reserve and utilized as additional capital. Thus, the financial needs of the company can be met by retaining a part of the annual profits. So, this may be regarded as reinvestment of profits. So, whatever profit generated by the company, they used to keep a small portion from that and that transferred to reserves, and whenever they are in need of capital they will utilize the same profits. So reinvestment of profits, which is also known as plowing back of profits. Then comes trade credit. So just as companies sell goods on credit, they also buy raw materials, components, stores, and spare parts on credit from different suppliers. Hence, outstanding amounts payable to trade creditors as well as bills payable relating to credit purchases are regarded as source of finance. So generally suppliers grant credit for a period of 3 to 6 months and thus provide short-term finance to the company. The next one is factoring. The amounts due to a company from customers on account of credit sale generally remain outstanding during the period of credit allowed, that is, till the dues are collected from the debtors. If necessary, book debts may be assigned to bank and cash realized in advance from the bank. By this arrangement, the responsibility of collecting the debtors' balances is taken over by the bank on payment of specified charges by the company. And this method of raising short term capital is known as factoring. Then, discounting bills of exchange. So, this method is widely used by the companies for raising short term finance. When goods are sold on credit, bills of exchange are generally drawn for acceptance by the buyers of goods. The bills so drawn are payable after 3 or 6 months, depending on the prevailing practice among traders. So instead of holding the bills till the date of maturity, the companies generally prefer to discount them with commercial banks on payment of a charge known as bank discount. So bills are endorsed in favor of the bank so as to enable it to realize the amount of bill on maturity from concerned parties. So that is known as discounting bills of exchange. Then comes bank overdraft, and credit. So, arranging cash credit and overdraft with commercial banks is a common method adapted by the companies for meeting short term financial requirements. Cash credit refers to an arrangement on a continuing basis whereby the commercial bank allows money to be drawn as advance from time to time within a specified limit is known as cash credit limit. So this facility is generated against the security of goods in stock or promissory notes bearing a second signature or other marketable instruments like government bonds. All those things we can see under bank overdraft and credit. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.